Thank you all for being here. I know it's a long morning now, afternoon, but and I'm trying not to be redundant, but let me start with Mr. Furlow. I know there's been discussions about moral hazard before. Can you just, I mean, there's a relationship between creating moral hazard or weakening the kind of the market discipline, which is kind of what we were talking about. Is there, how do you keep kind of both of those in balance, would you say? Just to make banks and depositors prudent, right, in the way they make those decisions.
Yeah, and that's why this discussion that we're having over where the threshold should be is so important. Again, it's not agreed to. One of the things that we did when we made our tag proposal was address a concern that was expressed by those of you in the Congress. When we were in the middle of that crisis, we were asking for a tag-like capability, and we kept hearing over and over again, well, what about moral hazard? And so we have to design a system that is balanced. It has to address issues such as moral hazard. Where that needs to be, that's the discussion. And until that time, we need a backstop.
Very good. Mr. Norquist, I'm so glad to see that you're on the panel. Can you just talk a little bit about how the coverage that's created interacts kind of with a broader regulatory framework, and would increasing those insurance limits it kind of focuses in on how the federal government is involved in the overall oversight. And I think there's a lot of us here today that are, you know, when you hear kind of that regulatory framework, it's overarching, right?
Banking is one of the most highly regulated industries we have, and it has periodic problems, which suggests that too much government doesn't fix everything. And now that we've pointed out some problems, people think more government would do the trick. I'm not sure that history looks kindly on that analysis. When we started with $2,500 guarantee, and then $5,000, and then blah, 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 blah.
Right.
And now we're talking about $250,000 up to $10 million. Increasing those is not necessarily a good idea and raises real questions. And we've seen directly from the 100,000 jump up to 100,000 what that did to the savings and loan industry and why it allowed people to take risks that they shouldn't have, or invest in their friends' things, or to the local union stuff that they wanted. And they ended up ruining a lot of people's lives and creating tremendous damage because of the government guarantee, and implicit government guarantees also can cause problems. We need to be clear what the government isn't doing as well as what it threatens to do.
Very good, thank you. Mrs. Castilla, reciprocal deposits are a means by which a bank can insure at least a portion of the deposits in the customer's respective deposit accounts above the FDIC's insurance coverage limit. So, given your experience leading a community bank through challenging times, how do reciprocal deposit arrangements help smaller banks manage liquidity and serve business customers?
Yeah, so I used to sit with customers, and we would go through call reports to see where they could place their $250,000 around the community and have it safe. Reciprocal deposits allow us to have a technology platform where we can do this more automated, and that they can have one entry point with me to be able to access multiple banks. So they have this trusted relationship with their banker, and they're able to identify which banks they would like to exclude. The great thing, too, about the reciprocal network is it automatically freezes out 4 and 5 rated CAMELS rated banks. And so troubled institutions can't go there to raise more funds. Going to the moral hazard issues, where if you have FDIC insurance, you could potentially have increasing exposures at troubled institutions and increase the exposure to the DIF if there's a failure. And so I'm able to use it. There's really not an amount that I can't handle, and I can one-way sell if I can't ingest all the deposits onto my own balance sheet. I can send that out just one way, so it's not reciprocal. It just goes one way out to the banking community, and then they're able to use that liquidity for their asset deployment.
Is there anything we should be doing that could help in your effort in the way that you handle those situations?
It's a great question, and I believe this committee, the reciprocal bill that came that actually allowed me to have more reciprocal access without it counting as broker deposits, it's exceptionally helpful, because this is organic deposits that I source that I'm able to feed into the system, and having that live to the broker deposit level of the 20% of my assets was a huge help for me and other community banks.
Thank you so much. I yield back, Chairman.